Welcome to the latest edition of Structured Finance Conversations. I'm Susanne Matern, head of EMEA Structured Finance, and today I'm joined by Alessandro Pighi, head of our EMEA RMBS team. And we are going to discuss the trends in the RMBS market. Welcome, Alessandro. Maybe let's start with the UK mortgage market. What are the latest trends you are seeing there?
Thank you, Susanne. The story for the UK mortgage market has been a story of uncertainty since the last budget of October 24. We've seen the first quarter of this year volumes particularly strong because people were trying to complete transactions before the stamp duty tax increase would just apply. As a result, Q2 was fairly disappointing in terms of volumes, and now there's a little bit of recovery since the summer, but it's a crawl rather than a sprint. We think demand is pretty flat, and supply constraints are really the safety net that prevents house price corrections, which would otherwise materialize. If you look at the reasons for this uncertainty, among other things, obviously there's a deterioration in the macro environment, but there is also policy risk. There are now rumors of wealth tax or an additional capital gain for larger properties, specifically in London. Overall, this uncertainty is driving away demand for investment properties, and the buy-to-let sector is affected for sure. On the owner-occupied space, instead, there are some good news. If the rumors of the FCA just relaxing a bit, the affordability calculations are going to be panning out and they're going to be deployed, that will just all in all increase credit availability for standard mortgage borrowers.
Yeah, affordability is actually a topic I wanted to ask you about because we did discuss it during the cost of living crisis. So what are the latest trends there?
Sure. For the affordability, if you look at headlines, they are better than they were in 23 and perhaps better even than 24. Wage growth has been strong over the past 2-3 years. Mortgage rates have decreased and the house price have been fairly flat. So all in all, headline figures better. But if you look a bit long term, we are still looking at a market that has appreciated quite a lot over the past decades, and the average borrower out there is struggling to access the market. So I don't think further decreasing rates are on the horizon, material further decrease. So a depreciation in house price is the only instrument or tool for affordability to improve in the long term.
Okay, thank you. Let's now move on to RMBS trends. What trends are you seeing in the RMBS market?
Performance-wise, European, so continent and UK, strong, stable performance. In terms of product, we've seen some, more frequent use of some type and structures than in the past. So in turn, I would say SRT, so risk transfer transaction for large UK banks, just to alleviate their risk-weighted assets on risk-weighted measures on their asset book. In Spain, we've seen quite a few reperforming loans, so legacy collateral with prior cures or prior restructuring. So these portfolios are changing hands fairly frequently, and therefore people are asking us to assign ratings. And lastly, coming back to the UK, niche products are getting more frequent. So second liens, lifetime mortgages, but also in the buy-to-let space, given the volumes are not particularly strong, originators are trying to expand and look at mixed use, look at small commercial, and slot those in a buy-to-let transaction. These teams are also present in the Dutch space and Dutch buy-to-let space.
Mm-hmm. And what are your credit views on these developments?
So if I go in turn for the SRTs, no particular concerns. Our rating frameworks captures well borrower attributes such as high LTV, high arrears, and first-time buyers. So all in all, we expect more credit enhancement, but there's not a lot more to it. For reperforming loans, we're a bit more selective. So the story there has been of a good performance up until 2022, 2023. When the euro rates started to increase, there's been a lag effect on performance, which has materialized in 24. And therefore, we are a bit more selective there. If we see portfolio stabilizing, we obviously look at these proposals. For stories where the stabilization is not quite there, we are a bit more vigilant. And lastly, on the UK space, so thinking about second liens and equity release, the execution there and structures there are quite tight and complex. All in all, the products are, well understood. So if I start with second liens, you've got a little bit more volatility in performance expected, and perhaps a little bit more default propensity or real propensity versus prime, because those mortgages are costlier. But if you look at a portfolio, a second lien portfolio, you expect the core to perhaps prepay faster than a standard mortgage, because people want to get better terms as soon as they can. Whilst for the underperforming part of the portfolio, perhaps cash flow are going to be more delayed than standard mortgages, because to envisage a straight foreclosure upon underperformance is probably not our base case realistic scenario. For equity release, as I said, the asset is well understood. The structures are a bit complex, so we expect structural protections to avoid situations where, for instance, senior bonds are matching adjusted, i.e. they have a scheduled principal suffering from cash leakage in certain scenarios where prepayments are a bit too high than expected, or cash is coming in earlier than expected due to mortality or morbidity events. And lastly, on the buy-to-let space, I mentioned more CRE, more mixed use. Those loans typically are larger and a bit more volatile in performance, so they attract a little bit more haircuts on the recovery side, and perhaps if there is large borrower concentration, a bit more scrutiny on the PD side as well.
Thank you, Alessandro, for joining us today. And if you have any questions or would like to continue the discussion, please send us a note to the address on the screen. Thanks for watching.